Welcome to The Explainer. I am so incredibly excited to dive into the ground reality of Module 2 of the CRE exam with you today. We're going to be looking at client relationship building, which is honestly the absolute lifeblood of this profession. Today, we're unpacking the core elements of the CRM framework, the nuances of suitability standards, and the 6 KYC factors. Plus, we'll be weighing the pros, like enhanced transparency and client protection, right against the very real cons and challenges, like the intense documentation requirements and managing the real-world impact of investment costs.
Consider this scenario for a second. If I'm wrong here, CRO will never trust me with clients. That quote right there, that establishes the massive stakes of what we're covering today. Mastering CRM and KYC isn't just about surviving a multiple-choice test. It is the absolute bedrock of your future career reputation and how you're going to legally and ethically protect your clients. This module carries serious weight in the CRO proficiency model, and for very good reason. So here's our roadmap for conquering all this dense regulatory information together. We'll start with the trust gauntlet, move into the 4 CRM pillars, then decode the KYC factors, navigate the real-world pros and cons of these rules, and finally wrap up with the final exam verdict. Let's get right into it.
Section 1, the Trust Gauntlet, Ground Reality of Regulation. This module is the absolute core of building and protecting client relationships. It's basically the ultimate rulebook for how you deal with the people trusting you with their financial futures, and it's built entirely around the principles of transparency and fairness.
Now, your mandate here is simple and absolute. Target 100% accuracy on suitability and classification. For the CIOE exam, you literally cannot miss a suitability or classification question. Treat any uncertainty as a giant, flashing red flag in your prep, because CIRE certainly will. The rules here are incredibly strict because the cost of getting it wrong is just way too high.
Section 2, the 4 CRM pillars, the ultimate shield. I want you to think of the client relationship model framework as a giant shield, built to govern all your client interactions. Its primary design is to protect the client. But listen, if you understand and execute these 4 non-negotiable pillars correctly, it also serves as an impenetrable shield for your own practice.
Let's look at the first pillar, Relationship Disclosure, or RDI. Think of this as your essential welcome and transparency document. The absolutely critical rule is that it has to be provided at account opening, meaning before any transaction takes place. It lays out the whole shebang, the products and services you offer, your complete fee schedule, how the firm is regulated by CIRE, CIPF protection, and your explicit duty to assess suitability. Seriously, if you execute a trade before handing this disclosure over, your firm is instantly offside.
Okay, let's dive into the next pillar, conflicts of interest. Under CIRE's client-focused reforms, there is a mandatory progression you've got to follow. First, you have to identify all potential or actual conflicts. Then, disclose them clearly in writing to the client before a transaction. Next, you must manage the conflict in the client's best interest or avoid it entirely if it just can't be resolved. You can't merely disclose and proceed if a conflict harms the client. Take proprietary mutual funds that pay higher trailing commissions to your firm, for example. That is a classic conflict. You have to prove your recommendation puts the client first.
Ultimately, it all boils down to one absolutely crucial formula. Suitability equals know your client plus know your product. This is the single most tested concept, folks, and suitability isn't some one-and-done deal. It's required at account opening, for every single trade or recommendation you make, and on an ongoing basis whenever a client's circumstances change, the portfolio drifts, or a significant chunk of time passes. It ensures that every piece of advice is specifically appropriate for that one individual.
The final pillar is account performance reporting. Under CRM2 regulations, you're required to provide an annual report for all retail clients. It's got to show a personalized, money-weighted rate of return. But here is the major transparency upgrade. All charges and fees paid must be shown in actual dollar terms, not just percentages. This is specifically designed so clients can truly judge the real-world impact of fees on their wealth, rather than just seeing a tiny percentage and brushing it off.
Section 3, Decoding the KYC Factors, the Blueprint. Now we're going to move into exactly how we classify clients and build their profile using the Master KYC document, the New Account Application Form, or NAF.
Let's examine how the accredited investor, or AI, thresholds are defined under NI 45-106. You've got the financial asset test, which is over $1 million excluding the primary residence. Then there's the net income test, over $200,000 or $300,000 with a spouse for 2 years. And finally, the net asset test, over $5 million, which actually can include the home. But watch out for the ultimate exam trap here. AI status only allows them to buy exempt market securities. It does not automatically make them an institutional client. They are still legally retail clients, meaning full retail suitability protection still applies to every single recommendation you make. To assess that suitability, you have to evaluate 6 specific KYC factors. Financial circumstances determine risk capacity. Personal circumstances shape goals. Investment knowledge ranges from novice to expert and limits product complexity. Risk profile combines tolerance and capacity. Investment objectives range from capital preservation all the way to speculation, and finally, the investment time horizon. Now, here's a critical rule to remember. A short time horizon of under 3 years strictly demands capital-stable products, no matter what their other factors say. This brings us to the most heavily tested concept in the entire module, the lower of rule. So risk tolerance is your psychological willingness to accept market swings, right? But risk capacity is your financial ability to withstand actual losses. Imagine a super wealthy client with massive financial capacity, but who is psychologically terrified of losing money. The rule dictates you must base your recommendation on the lower of the 2 factors. And this brilliantly illustrates the point. You cannot push a fearful client into equities just because they can financially afford to lose the money. Section 4. Navigating pros and cons, the weight of the armor. Let's pivot to the ground reality challenges of the job. We've got to balance the incredible pros of client transparency and protection against the really heavy compliance burden of documentation and the challenge of managing the impact of investment costs. Part of managing that reality involves third parties. A power of attorney, or POA, has the legal authority to give instructions and transact on behalf of the client. But remember your obligations here. You absolutely must verify the legal document before acting, and crucially, you are still bound by the client's original KYC suitability profile. A POA simply cannot just show up and drastically alter a conservative client's risk profile to speculation. It doesn't work like that. Let's see how this builds a sharp contrast. A trusted contact person, or TCP, is fundamentally different from a POA. They are an emergency contact only. I mean it, they have absolutely zero legal authority to trade or give instructions. Let me be very clear for your exam. If you suspect financial exploitation, a TCP still cannot give you instructions to sell an asset. You contact them, sure, but you strictly follow your firm's escalation process.
Now, let's look at the impact of costs on suitability. This is where the rubber really meets the road in client protection. MERs and TERs, they are an ongoing annual drag on returns. Even a tiny 1% difference compounds massively over 20 years, so you have to justify higher-cost products with superior value. Then you have front or back loads, especially deferred sales charges, which reduce the proceeds received and create severe liquidity traps for clients who might actually need their funds soon. And consider another issue, high portfolio turnover. Frequent trading can trigger massive, unexpected tax bills in non-registered accounts. Managing these cost drags is a literal daily requirement of suitability.
Which brings us to the golden rule of regulatory compliance. If it isn't documented, it didn't happen. The intense documentation requirements mean that every substantive client interaction, meetings, phone calls, advice given, client decisions, and any NAFS updates must be meticulously recorded. It is a heavy burden? Absolutely. But this administrative weight is the required armor that ensures transparency and honestly acts as your only defense in an audit.
Section 5, the final exam verdict, real-world stakes. Let's bring this explainer home by connecting these strict rules directly to your future standing as a CRO-regulated advisor. I need you to lock this number into your brain right now for the exam. 7. You must retain all client records for 7 years after an account is closed. This is a highly tested number for sure, but beyond the exam, it perfectly illustrates the incredibly long tail of accountability and responsibility you carry for every single client relationship you build.
I want to leave you with this final thought. Is the heavy burden of documentation worth the ultimate price of client protection? Think like a true professional here. The ground reality is that yes, the paperwork is dense, the rules are unforgiving, and the cost analysis is complex. But this entire gauntlet exists to forge the deep, verifiable trust required to manage someone's life savings. Master these CRM pillars and KYC factors, and you're not just going to conquer the series exam, you're going to build a resilient, client-first practice. Thanks for joining me on this explainer. Keep studying and stay focused.